Well, as Tom mentioned, it's been an exciting week's punting on the markets. Private equity has bounced out early, sizing up the big wealth business Perpetual. Tabcorp went for an each-way bet with the demerger of its casino and wagering businesses, and the whips have really started cracking when the cashed-up Packer stable started breathing down the neck of the Ten network. As Neil Woolrich reports, it could be just the start of some very high-stakes corporate jockeying.
4 years after James Packer started selling down the family stake in Channel 9, the media scion has come bursting back into free-to-air television. The billionaire this week sent share prices racing and probably put a few television executives on edge after snapping up an 18% stake in Network 10 for $280 million.
I think it's a dangerous game to get into as a rule because, 20% you can end up owning a significant portion of a company with very little control. You have to really know the register and know the industry, and in this case that's probably a very sensible move, but I would imagine most players wouldn't be confident enough to commit to 20% of a company without some sort of formal role already in place.
James Packer's raid came in the same week Network 10 executives outlined their plans to revive the ailing broadcaster, adding an hour of nightly news coverage and starting a new digital channel next year. But in a briefing to analysts and the media this week, 10's executive chairman Nick Falloon, who was ousted as PBL chief executive in 2001, refused to be drawn on whether those plans could be derailed by the group's new major shareholder.
We have actually had a brief conversation. We will get together at some stage in the near term, but we will not be, and I repeat, we will not be answering questions and speculating on the effect of the recent activity in our share price.
Whatever James Packer's grab might mean for Network 10, one thing appears certain for the broader market. Deal-making is back. On Thursday, the NSX-listed Sunrise announced it's been approached by Spain's Ebro in a $600 million takeover bid. Then on Friday, it was revealed the Australian Securities Exchange itself was in talks to merge with Singapore Stock Exchange in a $14 billion union.
The world's growing slower than it was pre-GFC. It's getting harder and harder for companies to deliver organic earnings growth. They have to look for where they can achieve growth, and so people are expanding within their industry. We've seen a lot in the mining services area.
Look, the most significant impact on M&A is confidence. In order to make significant acquisitions, a CEO from a corporate really needs to have confidence both in their own business and confidence in the business that they're buying. As the cycle continues to turn and confidence returns to the Australian market, that's going to be the biggest driver of M&A.
Investment banker John Stewart is expecting the gradual pickup in big transactions to continue into the new year, with mining and agricultural firms the most likely targets.
Because Australia has an above-average growth rate relative to the rest of the developed world, what we're seeing is, even despite an increase in the currency, we're seeing a lot of interest from foreign investors in Australian assets, and I think that will continue as well.
And there are sure signs that access to credit has improved markedly from the darkest days of the GFC. BHP Billiton recently raised $45 billion for its tilt at Potash Corporation, while two private equity firms mustered nearly $3 billion to buy out the private hospital operator Healthscope.
I'd say the availability of money isn't as good as it was pre-GFC, but certainly the cost has really come back down pretty much to the same level as it was.
With all the talk of quantitative easing in the States continuing or increasing, that maybe these private equity firms will be able to access levels of cash at quite cheap levels for a while, so we may see a fair amount of activity still.
Another company in the takeover spotlight this week was the Australian fund manager Perpetual. It's being stalked by one of the biggest names in private equity, Kohlberg Kravis Roberts, which rose to fame in the United States through its takeover of RJR Nabisco in 1989. EL&C Baillieu's head of research, Ivor Rees, expects a couple more significant deals will come along by the end of the year.
If you think about the bidding for Perpetual from KKR, it's a household name, it's very well known, it's an established franchise, very strong cash flows. Those sorts of names are the ones that are being targeted.
And on the local market, there's a long list of likely suspects. Among them, Foster's, which recently announced plans to split its beer and wine divisions, AXA Asia Pacific, whose French parent still wants to sell despite the National Australia Bank's offer being rebuffed on competition grounds, and smaller but successful firms like JB Hi-Fi or carsales.com. Aurora Capital's Chief Investment Officer John Corr says his firm looks for short-term inefficiencies in takeovers and becomes very active in live corporate deals.
It certainly keeps us busier, and we see a lot more opportunities, and that's generally a good thing for our investors. We see some real opportunities in the Australian takeover space, and and when corporate activity's on, we tend to have our better returns.
And the Australian market continues to trade on relatively low price-earnings multiples, which could tempt foreign buyers, notwithstanding the high Australian dollar.
I would say the thing that's going to restrain our market is political activity. So if our politicians in Canberra are quiet, the market will just keep edging up in a nice gradual way. If our politicians are rambunctious and start beating industries around, it'll be very difficult for our market to make headway.
And that's looking like more than just a remote possibility, with both sides of politics lining up for another spot of bank bashing this week, and the government still coming to blows with resources companies over the mining profits tax.